Hello friends, the purpose of this channel is to impart financial literacy, which will enable you to make better financial decisions for yourself. We regularly upload new videos on personal finance, so please don't forget to like and subscribe to our channel to become financially strong and independent. The topic for this video is mutual funds. Every time we look at different investment options, the one name that constantly gets mentioned is mutual funds. Mutual funds are undoubtedly one of the best investment options available. However, most of us fail to understand what they are and are often left confused with it. So, what are mutual funds and how do they work? Let's begin with a question. How many of us are confident when it comes to investing money? The reality is very few. Some of us don't have the money, some don't understand investments, some simply don't have the time to investigate it, some are always worried about losing their money, and some of us are too lazy and prefer keeping our money in bank accounts. That's when mutual funds were introduced many years ago to solve many, if not all, problems related to investing and helping individuals manage their money. Investment professionals or fund managers reached out to individuals and explained how they could save people's time and efforts while taking the responsibility of managing money for them. Fund manager Smith, who is an expert at investing, advised individuals that he is going to invest in the top 100 companies in America, and anyone interested to do the same should let him know. After listening to him, a lot of people came forward with their amounts of money. Jack came with $50, Paul came with $400, Lisa contributed $1,000, and Raj contributed $250,000, and so on. Altogether, the total amount accumulated was $10 million. Now, like fund manager Smith had mentioned, he went ahead, split, and invested this $10 million in the top 100 companies in America, which as of today include Apple, Google, Microsoft, Facebook, Visa, Berkshire Hathaway, and others. For understanding purposes, let's assume that all these companies appreciated 10% in value. If that was the case, Jack's capital would grow from $50 to $55, Paul's capital would grow from $400 to $440, Lisa's capital from $1,000 to $1,100, and Raj's capital from $250,000 to $275,000, representing the growth in the top 100 companies in America. So basically what Mr. Smith really did here was let the public know that he's willing to invest money on behalf of the people to help them generate returns on their capital. Interested individuals provided him with the money that he then invested as per his mandate. Through the investments, he generated returns that were then passed back to the investors because it was their money to start with, so the growth should be theirs too. This is basically what a mutual fund is. A pool of funds accumulated from numerous investors like you and me that are then professionally managed to generate returns for the investors by investing in stocks, bonds, and other financial products. Now the question arises, why is Smith willing to do all of this for us? The reason is fees. Mutual funds charge investors a fee for managing money for clients, which is the fund's source of revenue, and it could range from anywhere between 0.5 to 2.5% of the total money. That's why they are willing to manage the money for us. But what is so great about mutual funds that has made it one of the most prominent investment options? There are 5 reasons for the same. The key reason why an individual puts money in a mutual fund is to take advantage of professional management that the fund offers, like we described above with the example of Mr. Smith. Fund managers are highly skilled individuals whose day job is to research and find companies that will grow in value. They have the expertise when it comes to investing and resources that are not commonly available to every investor. It saves both our time and efforts, and we can keep our focus on what we are good at and let them manage our money. Mutual funds also allow you to invest in small amounts, which means you do not need to have a large capital to invest, which is a common misconception among the less wealthy. To give you an example, you could start with as low as $25. Mutual fund provides diversification benefits, which means not all your eggs are in one basket. If you had only one and it breaks, you would lose everything, right? Let's say you have $500 to invest. If you were to buy individual companies, you probably would be able to buy only 2 or 3 stocks. However, with the same $500, you would be able to invest in the top 100 companies like in our example. Mutual funds are regulated and overseen by financial watchdogs for investors' protection, since billions of dollars are invested in mutual funds across the world. Mutual funds come with different options and variety. There are plenty of mutual fund options available there that you could select from. For example, you might not want the top 100 companies to be from America, but top 50 around the world. All you would need to do is seek a mutual fund that has that mandate and invest in it. Remember, mutual funds are subject to market among other risks. It is recommended you meet with your financial advisor before deciding to invest in mutual funds. I hope this video helped you understand what a mutual fund is and what makes them so popular in the investment world. If you have any questions, please feel free to comment in the box below. Please don't forget to like and subscribe to our channel to never miss our upcoming videos.